For the last several years, I have heard buyers here in California say the exact same thing. I'm waiting for home prices in California to finally crash. And listen, I understand why. Mortgage rates went up dramatically years ago. Affordability got crushed. Insurance became an entire mess here in the state. The cost of living continued to rise. Logically, you would think that California home prices eventually have to collapse, but that's not what actually happened. California's market is actually repricing right now, just not in the way that people expected. Some homes are getting multiple offers again. Some highly desirable neighborhoods are still producing bidding wars. Meanwhile, other properties are sitting on the market, taking price reductions, or struggling to attract serious buyers. So how can both of these things be happening at the same time? Because buyers are no longer simply pricing the house. They are pricing the risk of owning that house. They are looking at the insurance, the HOA, the property taxes, the repair costs, the location, the future resale audience. Even when the asking price has not changed, the actual cost and financial risk of owning that home may have increased substantially. By the end of this video, I'm going to share with you which types of California properties are still gaining at a premium, which ones are quietly being discounted, and why waiting for the entire state to crash may be a fool's errand. Now, if we haven't met yet, my name is Arjun Dhingra. I'm a mortgage advisor of 25 years, many of them right here in the San Francisco Bay Area market. We have helped thousands of families take root here or buy investment property in a really competitive space. And in helping all these buyers over the years, I've learned something about what happens from the inside, not just from the headlines, but I see the actual loan files, the profiles of these buyers. I see insurance quotes, monthly payments. I see all the buyers who compete really aggressively and those that walk away because the numbers no longer make sense. And if me or my team can be of any help to you, please send me a DM on Instagram at Arjun Mortgage, and we would be honored to help you in any way we can, putting together a plan or a strategy to buy tomorrow or next year. So let's break down what this whole California is repricing concept actually means. The first thing that people must understand is that California is not one housing market. We talk about it from time to time like it's one massive market, but that is becoming less useful day by day. San Francisco behaves completely differently than Oakland, which is just across the water. Marin behaves very differently than Sacramento. Palo Alto doesn't act like Stockton. Los Angeles behaves differently than Fresno. And even within one city, two neighborhoods can act completely different from one another, depending on the buyer pool, the property type, the school district, the insurance exposure, and the amount of available inventory. California has always marched to its own beat. It's a vast and completely dynamic economy, and that doesn't stop at just its housing market. San Francisco, right here locally, tends to march to its own beat, completely independent or irrespective of the rest of the state. Today, there are really three forms of repricing happening. The first is sticker price repricing. This is the obvious one. The seller cuts the asking price or the property sells below what a similar home might have sold for a year or two ago. The second is monthly cost repricing. The home may cost the same on paper, but the mortgage payment, taxes, insurance, HOA dues, and maintenance make it a much more expensive property to own. The third is risk repricing. Buyers are deciding that certain properties are simply not worth taking on because the future costs are too unpredictable. That is really the major shift. California is not simply becoming cheaper or more expensive in a simple sense. Demand is concentrating into properties that feel scarce, predictable, and defensible. And that explains exactly why, in this crazy state, one property can sell immediately for over asking, and just a mile away, another property can sit for months with no offers. Now, here's the part that gets missed in every housing conversation. The listing price is not the complete price of the home. Buyers do not live inside of a purchase price. They live inside of a monthly payment. Let me give you a simple example. Imagine two homes that both cost $1.2 million. Property A is a single family home. It has no HOA. Insurance is manageable. The roof and major systems are in decent condition. Now, imagine property B. It also costs $1.2 million, but it has a $700 monthly HOA. The insurance costs several $100s more each month. The HOA may also be discussing a future assessment because the building needs roof work, siding repairs, or structural maintenance. Same purchase price, completely different ownership experience. Property B could easily cost $1,000 more per month than property A. That's $12,000 a year. That's $60,000 over 5 years without even factoring in future increases. And here's another way to understand it. An extra $500 a month in HOA dues, insurance, or other recurring obligation can consume roughly the same monthly budget as approximately $75,000 to $80,000 of mortgage principal, depending on the rate. So when somebody says this condo is $100,000 $100,000 cheaper. The real question is it actually cheaper once we calculate the entire payment? A lot of buyers come into this process only fixated on principal and interest. Then we add property taxes. Then we add homeowners insurance. Then we add HOA. Then supplemental tax bills. Then maintenance. Then suddenly the number that they thought they were budgeting for is nowhere near the real cost. That is why I believe, and this is a bold statement, that the California housing crash may have actually already happened. It happened in the monthly payment. The sticker price may not have collapsed, but affordability did. Now, another reason that California has not experienced the type of housing crash that so many people have been expecting for a long time is that two owners can live in nearly identical homes and have dramatically different monthly costs. Imagine one homeowner bought 15 years ago. They may have a very small mortgage balance. They may have refinanced into a rate around 3%. Their property tax basis is protected by Prop 13, which generally limits annual increases in assessed value until a qualifying ownership change or reassessment event occurs. Now imagine the new buyer purchasing the house next door today. That buyer may have a larger mortgage balance, a significantly higher interest rate, a new property tax basis tied closely to the current purchase price, higher insurance premiums, possibly higher maintenance costs as well. They may be living in literally two identical homes right next to each other, but financially they're living in two completely different economies. That is what creates the lock-in effect. The long-term owner may want a larger house, different location, different lifestyle. But then they look at what the people next door are actually paying and they ask, why would I give up my very low mortgage rate and my low property tax basis just to double it for another house? And that can be hard to argue with. And so they stay. That reduces inventory, and reduced affordability does not always force sellers to slash prices. Sometimes it just simply creates fewer transactions. Buyers cannot afford to move. Sellers do not want to move. The market freezes. And this is very different from a traditional crash where distressed homeowners are just forced to sell at any price. California has plenty of financial pressure, but in many markets, it still does not have enough forced selling to actually warrant any sort of a collapse. The definition of a quality property has also changed here in California. 5 years ago, when rates were extremely low and prices were rising rapidly, buyers were willing to overlook a lot. An outdated kitchen, no problem. Strange and awkward floor plan, no problem. A high HOA, we'll work with it. A difficult insurance area, we'll figure it out later. Cheap money made buyers far more forgiving. And also the speed that the market was moving at didn't help anything. Strong appreciation makes weak purchases look smart. Remember that. Today, buyers are far more selective. They are paying a premium for scarce single-family homes. They are paying a premium for good neighborhoods. They are paying a premium for strong school districts. They are paying a premium for predictable insurance and manageable maintenance. In other words, predictability has become a luxury. The properties facing the most resistance tend to have costs that buyers have no control over. That could include an HOA-heavy condo, a building with deferred maintenance, a home located in an area where insurance is difficult or extremely expensive, a property with limited resale audience, or a home requiring substantial repairs immediately after closing. San Francisco condos are a fantastic example of this. I would not describe the entire condo market as actually crashing, because that is overly simplistic and frankly not accurate. But certain condo segments have faced far more resistance than scarce single-family homes. And why is that? Because a condo buyer is not just buying the unit. They are also buying into the health of the HOA, the insurance policy, the reserve budget, the possibility of future assessments, the condition of the entire building. Let's imagine two buyers. Buyer one purchases a small single-family home in a highly desirable neighborhood with broad future demand. Buyer two purchases a slightly cheaper condo with high monthly dues, a weak HOA reserve position, and upcoming building work. The condo may look cheaper on closing day, but over 5 or 10 years, the single-family home may prove to be the stronger and more defensible asset. That does not mean that all condos are bad, guys. Don't get me wrong. It just means that buyers must understand fully what they are buying beyond the front door of the unit. Now, I do not believe that the old rules of real estate wealth building are dead by any means, but I do think the standard has changed. For a long time, the advice has always been buy something and hold it. Let appreciation take care of the rest. That worked very well for many people. But today, appreciation cannot be the only thing rescuing a weak purchase. The property needs to make sense on its own. I call this buying defensible real estate, and I would use 4 filters. Filter number 1. Can you survive the full ownership cost? Not just today's payments, but what happens if insurance increases? What happens if the HOA dues rise? What happens if the property requires a $25,000 repair? Do you still have emergency reserves after closing? Here's filter number 2. Who will buy this property next? This is one of the most important questions in real estate. You may personally love the home, but how large is that future resale audience? Is the property appealing to families, professionals, first-time buyers, investors? Or does the property require such a specific buyer that it may be very difficult to sell in the the future. Filter number 3, which expenses can you actually control? You can choose when to remodel the kitchen, you can postpone cosmetic upgrades, but you cannot control a failing HOA. You cannot personally control an entire regional insurance market. You cannot move the property away from a wildfire exposure zone. The more uncontrollable cost a property has, the more carefully the purchase needs to be evaluated. Filter number 4, does the financing match the plan? A buyer planning to hold a home for 30 years is going to have an entirely different mortgage strategy and approach than someone who's planning on leaving after 5 to 7 years. A buyer receiving RSUs, bonuses, or irregular business income may need a different liquidity strategy than someone who's earning a fixed salary. The goal is to not just simply get approved. The goal is to match the debt to ownership plan. Anybody can hand you a mortgage. You don't need to talk to anyone like me to get one. You can just go online and apply for one. They're like credit cards these days. The real question and the real place where somebody like me comes in is determining whether or not that mortgage supports the rest of your financial life. So should buyers keep waiting? Sometimes, yes. Waiting makes sense if the payment is just simply not sustainable. And for a lot of buyers, that is the case, particularly here in San Francisco. Waiting makes sense if it was going to leave you with no emergency reserves after closing. It makes sense if your job or income is unstable. It makes sense if the only available property is going to force you to take on risks that you would otherwise never take on or be financially prepared to handle. There's nothing wrong with renting when renting is a financially healthier situation for you. A lot of people in our industry say that rent is a waste of money, you should never do it, it's terrible, but everything is based on one's personal timing and situation. But also, guys, waiting because you believe that every property in California is going to become considerably cheaper is a very different strategy. Rates and prices do not always fall together. In fact, if mortgage rates move lower, which they are expected to potentially later this year or early next year, then more buyers enter the market and prices don't stay where they're at, they actually will climb because of increased competition. Inventory may improve modestly, but the best properties still retain a scarcity premium. This is why often statewide headlines are still very misleading. You may see a report saying that home prices are falling in San Jose, Fresno, Oakland, Dublin, Stockton, Palo Alto, Lake Tahoe, or even certain neighborhoods in San Francisco. But a small decline does not at all point to a wide collapse. A home selling for 98% of its list price is not exactly the Great Depression with granite countertops. You have to look city by city, neighborhood by neighborhood, property type to property type. Some properties will continue to command premiums. Some will be discounted because of insurance, HOA costs, poor condition, or just weaker demand. The market is separating. It is not one housing market here in California, and it is not all moving down together. There are also several larger forces at play here that could have a big impact on California's housing market. The governor's race matters. Different candidates will take different approaches to housing policy. A candidate forced on reducing red tape, speeding up approvals, and encouraging builders could eventually bring more housing supply to areas that desperately need it. That would not solve the housing shortage overnight, don't get me wrong, but increased supply would certainly help cool certain markets over time. Political uncertainty and upcoming midterm elections can also affect consumer confidence, investment decisions, tax expectations, and financial markets. Global conflict matters as well. We can affect oil prices, inflation, bond yields, and ultimately mortgage rates. Mortgage rates do not move only because of the Federal Reserve. They also respond to inflation expectations and broader market forces. If energy prices surge and inflation becomes a large concern, that could keep borrowing costs elevated. And then California has the opposite pressure coming from technology. AI company growth, tech expansion, potential IPOs, stock compensation, and cash-heavy buyers. These wealth events can create intense localized housing demand, particularly in the Bay Area and other tech-concentrated parts of the state. So California is being pushed in many different directions all at once. High rates are limiting affordability, insurance cost is increasing ownership cost, politics may eventually influence housing supply, and technology wealth is supporting premium neighborhoods. This is exactly why simple crash or boom predictions are effectively useless, guys. So in conclusion, I will tell you that California is not becoming cheaper. And in the same breath, California is not simply becoming more expensive. California is just becoming more selective. Buyers are more selective. Lenders are becoming more selective. Insurance companies are becoming more selective. Investors are becoming more selective. The market is rewarding properties that are scarce, predictable, and easy to own. It is discounting properties with uncontrolled expenses, limited resale demand, and greater long-term uncertainty. So stop asking only, is the California market going up or down? The better question is, how is this specific property being repriced? right now? Or is it becoming more desirable or more expensive or risky to own? Will another buyer want it in 5 to 10 years from now? And does the entire cost of ownership actually make sense for your life? Those are the questions that matter right now. Now, whether you're deciding to buy, continue renting, sell a property, or move up into a different neighborhood, do not evaluate your decision using headlines alone. Compare the complete monthly payment, compare insurance, compare taxes, compare HOA dues, compare future repairs, compare the financing, and above all, compare the long-term resale audience. If you would like help comparing the true cost of two very different properties or understanding how a move would affect your financing, reach out to me and my team. Again, via Instagram at Arjun Mortgage. It is me that answers all those DMs. We can set up a time to consult you and help put together a plan for whether it's the near term or the long term as to how you're going to break into this market. My information is in the description below, along with our website, so make sure to check us out. And again, let us know how we can serve you in any way. Remember, guys, California is just being repriced. The question is whether the property that you are considering is being repriced in your favor. Thanks for watching, guys, and we'll catch you on the next topic here on my channel. Please, if you found this video useful, share it with someone that you feel might benefit from its information as well. Make sure to give this video a like and also subscribe to my channel so that we can bring more content like this to people like you. I really appreciate it. Look forward to connecting soon, and we'll see you on the next topic.